Now, welcome to our today's class, that is economics. And now for today's class, we're going to talk about the national income accounting. National income accounting, after which we'll also be able to talk about money and banking. Now, when you talk of national income, in this case, it is just the total value of goods and services that are produced in a country. The total value of goods and services that are produced in a country. Now, remember in this case, a country will have what we call the households and farms. And in this case is how we normally analyze this. We have the households, and then we'll also have what we call the farms. Now, there is what the households are given to the farms, and then what the farms are given to the households. Are we together? So in this case, for these farms, for the farms in this case, they will receive what we call the factor incomes. I mean, they will be given by the households what we call the factor services. And the factor services in this case is now the labor. Factor services. Pando kuna labor. But now for this case, as a result of labor, the farms are now giving back to these households what we call in the what? The wages. The factor services are just the factor inputs. And the factor inputs in production, we have in the capital labor and what? We also have been capital labor, we also have land. So in that case, we can also have rent, we can also have what we call the what? The interest, which is out of the capital. I mean, that is labor, we have land, and we also have the capital, meaning that the factor inputs in this case will have rent and will have the interest. That is what the farm is given. After receiving those services, they will be able to give what we call in the factor, incomes. And the factor incomes in this case is the wages, the rent, and the interest. Then again, they will also have to incur what we call the expenditure. I mean, they will also have to produce the goods. So after they produce the goods, in this case, it means that they produce the goods. I can have this out to here, then that. So if they produce the goods, this is on the if they produce goods, in this case is now the output, yes, which in this case the output, we are talking about the goods and services. So the output, if they produce the goods, now the households are going to buy the goods. So this is now where we'll have the expenditure. And the expenditure in this case is as a result of what? The payment of goods. That is now what we mean in this case when we talk about the national income accounting. So at the end of it, you will realize that the income, that is the factor income, it just equals to the expenditure, which is also equal to what we call in the what? The output. Because in this case, you have to pay for the goods as you are giving out the output to the consumers or the households as they pay for the goods. And at the end of it, you will find that the expenditure that they are spending out of the goods that they are paying will just be the same as the output. Now we have the methods of computing. Methods of computing national income. National income. The methods of computing national income. Number one is what we call the net approach, or what we call the net income approach. The net income approach. When we talk about the net income approach, we also call it the income approaches, which in this case we normally base on the factor incomes. And the factor incomes in this case is whereby we have in the wages, So for you to get the national income here, you just take the employment income, which in this case is the wages, employment income, that is out of the wages. You will also add the rent income, which in this case is out of rent. You will also add the interest income, which is out of the capital, interest income. And then you'll also add the profits. The profits is out of the enterprise. In this case, for the net income, which is also the income approach I've said you based on the factor income, on the factors of production. Then number two, we also have what we call the expenditure approach. The expenditure approach. Now, on the expenditure approach, in this case, the expenditure will be given by, you will take the consumption, you add the government expenditure, and then you also add the investment also. Then you also add the exports minus the imports. This is consumption, that is the consumer expenditure, or what we call the consumption. You add the government expenditure, you also add the investment, then you also add the exports, you minus the imports. Then the other one, number three, is what we call the value added. Now, value added is also what we call the output method. Remember, what we're basing on is this one, the expenditure, and also this is the factor incomes. That is what we're basing on this regard. So in this case, for the value added, you normally take the summation of all the revenues, or generally, you just take the summation of the total revenues, you rest the amount that is paid to the other firms for either for the commodities supplied or for the services what rendered. That is now what you do when you get for the value added, for the summation or the totals. So we'll also be able to see some of those how we can use these methods in computation of national income. Then the other one, there are also complications in computation of national incomes. Complications in computation of national income. National income. Now, the complication number one is what we call the factor cost. What we call the factor cost. And the market price. Market price. Factor cost and the market price. Now, national expenditure in this case is normally computed using the market price, meaning that when we talk about the national expenditure here, the market price, in this case is inclusive of the indirect taxes, and also what we call the subsidies, which in this case we know for the indirect taxes, they normally affect prices by raising the prices. Subsidies in this case, we know they normally reduce the prices. But now, for the national income and national output, we normally, or it is calculated using the factor cost. So this is now what you normally do. When you are given the market price, in this case, you normally take the factor cost, you add the indirect taxes, the factor cost, you add the indirect taxes then you less the subsidies. That is how you compute the market price. Generally, what we'll be basing on is the gross domestic product, whereby in this case, when we talk about the GDP, this refers to what is produced within a geographical location, or generally what is produced within a geographical boundaries of a country. Then when you given, they want you to get the factor cost. The factor cost will now be the market price. The market price, you add, you minus the indirect taxes, then you add what we call in the subsidies. Indirect taxes, then you add what we call in the subsidies. Like for example, in this case, we have the GDP. When you talk about the GDP, I've said it's a gross domestic product. At market price, in this case, you normally take the GDP. At factor cost, you add the indirect taxes, then you less the subsidies. That is how you get the GDP at market price. Meaning that also, if you want to get the net national product at market price, you will also have to get the NNP at factor cost. You add the indirect taxes, then you less the subsidies. That is how you now get the net national product, and that is at the market price. Meaning that if you want to get the NDP at market price, at the factor cost, NDP at the market, not NDP, the GDP at factor cost, you will get the GDP at market price minus indirect taxes, then you'll add subsidies. Generally, in this case, this is now what we're making the subject of the formula, meaning that for the NNP at factor cost will also be given by ANP, that is the net national product at market price. You minus the indirect taxes, then you add the subsidies. That is the factor number one. Then the factor number two is what we call the depreciation. Or in other cases, we call it the capital consumption. This one will arise as a result of wear and tear allowances, which occurs in production. And therefore, in this case, when you given the gross, you less the depreciation, you normally get what we call the what? You normally get what we call the net. Gross minus the depreciation, normally you get what we call the gross. Meaning that if you are given the GDP, I less depreciation here, in that case, I will get what? The NDP. That is the net domestic product. Meaning that if I take the net domestic, the GNP, that is the gross national product, I less also the depreciation. Will now give us what we call the what? The NNP. That is also another factor. Then the factor number three is what we call the net factor income from abroad. 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 Now, when we talk of net factor income from abroad, is this income that is realized out of a foreign country. And therefore, in this case, if income from production activities, whether it is earned from abroad or in the domestic company or the domestic economy, it is supposed to be included on the national income. And therefore, for this case, we will get the net factor income from abroad. This one, the net factor income from abroad, because we've said we include both for the foreign and also for the what? The domestic. So in this case, you just take the residence income, you add the non-resident income. Non-resident income generally is now the income from abroad. So meaning that in this case, if you want to get the national income here, the national income here will be given by national income will be given by the domestic income, that is from the domestic country, then you add the net factor income from abroad. The net factor income from abroad. Then the last one is also the appreciation of stock prices. That is another factor. Appreciations of stock prices. When it's stock prices, in this case, we are talking about the securities. So if in this case, the value of the stocks of the farms in this case increases, it means also the national income in this case will have to do what? Will have also to increase. And therefore, in that case, when there are adjustments that have been made on the stock prices of an organization or on this case on the values of the farm, if there are any adjustment that they have been made, also means that also all the appropriate adjustment in all other areas need to be done. And that is the complications in computation of national income. Now, the last part is what we call the equilibrium income. Equilibrium income. Equilibrium income. So when you talk about the equilibrium income, this is that level of national income that shows no tendencies to changes. And in this case, equilibrium will exist where the total aggregate demand is equal to the total value of goods and services produced in a country. That is what we mean in this case. And when we talk about the aggregate demand, this case will be just the consumption, investment, you also add the government expenditure, you also add the exports, you minus the import. That is how you get the aggregate demand. So in this case, equilibrium, as I've said, is existing when the aggregate demand is equal to the what? The total value of goods and services that are produced in a country. So that is how you get the aggregate demand. So now, In this case, on the aggregate demand, we normally have what we call the injunctions, and there is also what we call the withdrawals. So when we talk about injections, in this case, are those that normally add the total income of the domestic farms. And in this case, for the injunctions, we normally have what we call the investments, the government expenditures, and what we call what? These ones, the investments, government expenditure, and the exports. In this case, we normally call them the what? Injections. As I've said, in this case, they normally add the income, or they are added to the income of domestic farms and what we call the households. Now, for the withdrawals, in this case, is any income that is not farm, is not passed through what we call the what? That is not passed through the flow of the national income. And in this case, they normally include what we call the savings, taxes, normally include savings, taxes, and also what we call the what? Imports. The imports. And therefore, at equilibrium, injection should always be equal to the what? Injection should always be equal to the withdrawals. This one should be equal to this at equilibrium. The injections in that case, they will also be equal to what we call the withdrawals, and that is at equilibrium. Now, the other thing is also what we call the national, the disposable income. Disposable income. Disposable income. Disposable income. Disposable income. Now, when you talk of disposable income, this is the income which in this case, this is the income which in this case, is the income that actually, which households actually have available to spend. They all normally have available in order to spend in that regard. And therefore, in this case, to get the disposable income, first you have to get what we call the personal income. And for the personal income, in this case, it will be given by the national income. The national income. You also add the transfer payments. Transfer payments in this case is just the government expenditures. You add the transfer payments, which in this case, not the government expenditure, but transfer payments in this case, we are talking about the pensions. Then you less now the government expenditure, which in this case, not government expenditure, but what we call the business taxes. Business taxes. Then you also less the social security fund. Social security fund. And then you also less the undistributed profits. Generally, the retained profits. You also add the undistributed profits, or what we call the retained earnings or the retained profits. Meaning that in this case, to get the disposable income will be given by the personal income minus the personal income taxes. The personal income taxes. Personal income taxes. That is how you get that value. So with that now, we can try an example. With that, we can try an example or regards to the same. In regards to the same, we can try an example. We do from the sitting of, from the sitting of, from the sitting of, from the sitting of, do November 2017. November 2017. That is the question number 7C. Question 7C. November 2017. Question 7C. Now, November 2017, question 7C, there is what we've been told that the data provided below represents estimated national income figures for our hypothetical economy in millions of shillings. Being given the gross national product at market price, depreciation allowance. We also have the depreciation allowance. Then we have indirect taxes less subsidies, business taxes, personal income taxes, government transfers, and then we also have what we call the retained profits. You are required, number one, the net. One is the net national product, and that is at market price. Now, net national product at market price, in this case, we've said, you normally take it by taking the net national product at factor cost. You add the indirect taxes, then you less the what? Subsidies. You less the subsidies. That is how you get the net national product at market price. However, in this case, what we've been given is the gross national product. So in that case, first we have to get the net national product. So we've been given the gross national product at market price. So meaning that for us to get the net national product, in this case, if I less the depreciation here, we'll get what we call the net national product at market what? Market price. So in this case, what is the gross national product at market price? We've been given as 39.92 minus depreciation allowance, which is 570. Whereby in that case, it will give us a value of how much? In that case, it will give us a value of to give us a value of 34.22. That is on Roman 1. Then on Roman number 2, I mean, we are not yet gotten this is now the net national product at market price. So we can now get the N, yeah, we have already, this is the NPP, NP at factor. Yeah, we were required at market price, which already we have it is here. Then Roman number 2. Roman number 2 is the net national product at factor cost. At factor cost. So to get the net national product at factor cost, in this case, it will be the net national product at market price, you less the indirect taxes Then you add what? The subsidies. You add the subsidies. So in this case, what is the net national product at market price? Is 34.22. Now we've been given there the indirect taxes less subsidies, meaning that in this case we'll less that the indirect taxes less subsidies, which is how much? We less 524. It will give us how much? That is 28.98. 98. And that is Roman number 2. Now Roman number 3, personal income. So personal income in this case, I've said it will be given by the national income. The national income, you add the national income, you add what? You also add the government transfer, which is also the transfer payment. Government transfer. You less the business taxes. You also less the social security funds, that is NSSFs. And also less the what? Undistributed profits, which are now the retained profits. So what is our national income here? National income is 28 what? 98. Are we together? Now remember we said in this case, the national income is, when we were talking about the market price and factor costs, the national income and national output are computed on the factor what? On the factor cost. And our factor cost in this case is 29.98. So in that case, you add the government transfers, which is 693. You also minus business in taxes, which is 214. There is no social security funds, but now we can also see there is retained profits of 230, which in that case it will give you how much? Add 693 minus 214 minus 230, which is 31.47. That is now the personal income. And the last one, number 4, is now the disposable income. Disposable income. So for the disposable income, in this case, disposable income will be the personal incomes, you minus the personal income taxes. Personal income taxes. Income taxes. And the personal income in this case is at 147. You minus the personal income taxes, which in that case is 763. 763, which in that case is how much? 2384. And that is how you compute that. That is how you compute that value. Can as well try another question. Can as well try another question. Try another question. You can as well try another question. Another question, which is in the sitting of November 2018, question number 7C. November 2018, question 7C. November 2018, question 7C. November 2018, question 7C. Now, the data provided below represents economic transaction for a hypothetical country in billions of shillings. We have the total output, intermediate purchases. We have for the agricultural sector, manufacturing sector, and we have the service sector. We've been given there the indirect taxes and fixed assets depreciation amount to 22 billion and 26 billion respectively. You are required the gross national product using the value added, using the value added. So in this case, for the value added, we say it is the total revenue less the amount that is paid for the services rendered or for the goods that were acquired. So in this case, there is purchases. So for the gross national income here, we will have for the agricultural, that is Roman 1, the agricultural here, agricultural, it will be 55,000 minus 24,000, which in that case, it will be how much? 55,000 minus 24,000. That is 31,000. Then we also have for the manufacturing sector, and the manufacturing will be 96,000 minus what we have in here in this case is how much? 63,000, which in that case is 96 minus 63, 33,000. Then the last one is what we call in the what? Which what we call in the service. And then for the service sector in this case is how much? The service sector in this case will be 71,000. You minus 42, 71,000 minus 42,000, which in this case will be equal to how much? 29,000. So using the value added, what will be the GNP? 33 plus 29 plus 33 plus 29 plus 31, which in that case is 90. That is Roman 1. Now, Roman number 2, we want to get the national domestic product at market price. So to get the national domestic product at market price, remember we said that when we talk of expenditure should be equal to the national income, should also be equal to the output. So in our case, the total income here, you just take the total output. The total output. And the total output in this case will be 55,000 plus 96,000. You also add 71,000, which in that case, it will give you how much? 222. 222,000. This is not the national, this is just the GDP, 220,000. So now, in this case, you want to get the net domestic product. The net domestic product in this case at market price will be given by the GDP. You minus the what? Depreciation. That is just the GDP. So in that case, it will be just 222,000. You minus the depreciation here, which we were given as how much? 26,000, which in this case, it will give you how much? 196 That is on market price, the NB at market price. Now, what about the net domestic product at factor cost? At factor cost in this case will be given by what? We said it will be the N what? NP at market price, you minus the what? Indirect taxes, then you add the what? Subsidies. So in this case, at the market price, we have how much? I mean, this is not an NDP. So in this case, it will be 196,000 minus the indirect taxes, which been given there as 22,000, which in that case, it will give you how much? 174. And that is how you are required to do from that case. Now, still on the national income, there is what we call the consumption function, or what we call the multiplier function. So when you talk about the consumption function is out of now the goods that are being consumed, the consumption function, whereby in this case, as I was talking about the aggregate demand, we say that for the aggregate demand in this case is equal to the national income. So generally, when we talk about the consumption function, this one is just explaining what is being consumed by the individuals. And therefore, for this case, for you to get the consumption function, which is C, is always A plus BY. BY, which is in this case, when we talk about A in this case is the marginal, I mean, is the autonomous consumption. Then B, this is now what we call the marginal propensity to consume. Marginal propensity to consume. Marginal propensity to consume in this case normally, it normally shows what has been consumed out of what we have in as the national income. Now, there is a question in this case. Before that, when you want to know the marginal propensity to consume, it is normally the change in the consumption. You normally take it as the change in consumption out of the change in national income. Generally, for the national incomes, we'll be using what we call in Y. That is how you get the marginal propensity to consume. Are we together? So meaning that in this case, we'll also have what we call the marginal propensity to save, which in this case, we are going to get it out of what we call the investment function. Now, there is a question that was asking about the factors that the determinants of consumption. The question that was asking about the determinants of consumptions. That should be in November, not November 2019. Yes, there is this question that is asking about the consumption, which is in the sitting of May 2019, question number 5C, 5D Roman 2. You are required to discuss You are required to discuss 7 factors. That is of May 2019, question number 5D, Roman 2. Discuss 7 factors that determine the level of consumption in a country. And that is out of the consumption function. And the determinants of the level of consumption in a company, number 1 is the rate of interest. If the interest iko chini, you're going to consume. Kama iko juu, in that case, you're not going to consume. Are we together? What do we mean? If in this case, like for example, if is on the interest, generally you want to obtain a loan. When we talk about loan, remember is giving rise to the interest. If you want to obtain a loan, kama interest iko chini, more people are going to go and what? Acquire the loan. But if the interest in this case is higher, more people will not be able to acquire the loan. The other one is also the relative prices of the goods and commodities and the services. If the prices are high, consumption itakuwa chini. If they are small, consumption will also be high. Also, we talk about the wealth. When we talk about the wealth, we are talking about the income. Kama uko na pesa, you will be able to consume that good. Lakini kama una pesa, you'll not be able to do the same. The money stock, which we also call it the liquidity, the liquid asset money. When you talk of liquid asset money or the money stock is the money that you have in hand, the liquid cash. Are we together? Ile pesa uko nayo in hand. Then the other one, you unanunuanga ukienda, for example, ukipitia pale kama uko na pesa kwa mfuko, at the end of it you will have to buy the commodity. Are we together? That is what we mean, the liquidity asset or the liquid asset. The other one, we also have the availability of consumer credit. If you have been given credit on a commodity or on a good, in that case, you'll also be able to buy the good. And also the attitude and the expectations of the consumers. And then again, we also have what we call the money illusions, whereby in this case, when we talk about money illusions, is whereby the consumers focus on the nominal value of money and they ignore the real value of what? The real value of money. Nominal value of money and they ignore the real value of money. You know, in this case, there is what we call the inflations. And there is when there is inflation, kumaanisha the value of money haiko juu, haiko chini. So in this case, they don't consider on the other factors that may affect the what? May affect the money. And that is what we mean when we talk about the consumption function. Then before that, I've said we have what we call in the marginal propensity to consume. Now, there is also out of saving functions. We are going to also talk about what we call the saving functions. And the saving functions also is giving rise to what we call the marginal propensity to save. Now, this is the amount out of what you have received out of the national income, the amount that you are now going to do what? To save. So meaning that for this one, you normally take it by taking the savings, the change in savings, you divide by change in the what? National income. Whereby in this case, the marginal propensity to save, marginal propensity to save plus the marginal propensity to consume should always be given by 1, should always be equal to 1. So if in this case I take MPC will always be 1 minus MP what? Marginal propensity to save. We also have what we call the average propensity to save. The average propensity to save. When we talk about the average, in this case, is the fraction of the national income or aggregate income that is normally devoted to the savings. So the average propensity to save will just be savings you divide by the national income. You can also be asked about the average propensity to consume, which in that case will just be consumption you divide by the national income. When I'm using Y in this case, I've said that is the national income. Are we together? That is what you need to know, or you need to understand on that case. Now let's talk about, that is the consumption function. Let's also talk about what we call the savings functions. Before that, we can try an example here. Before that, we can try an example in this case. No, this one is asking about the investment function, which is also the savings functions. So let's also talk about the savings functions before we talk about the question that I'm talking of. Savings. Savings functions. Savings functions. Now, national income in this case, majorly, we've said is normally being given by what we call the consumption plus savings. Are we together? Is normally given by consumption plus savings. So in this case, we know for the consumption, I've said the function is A plus what? BY. So meaning that this, for the national income here, it will be given by the A plus BY plus what? Savings, which is S. Are we together? So now, we group the like terms together. This will be Y minus BY. Are we together? Which should be equals to A. We are just developing the saving functions. Are we together? Are we together? Which in that case plus S. S, remember this is all the savings functions. So this will be 1 minus B. Are we together? Which in that case should be equals to A plus S. Now, 1 plus B we said is the what? Marginal propensity to do what? Whereby we take 1 minus marginal propensity to save will give us how much? If I take 1 minus marginal propensity to consume, sinitapata MPS. Sawa. So meaning that this one is Y MPS. Are we together? Which is marginal propensity to save, should be equals to A plus B. Are we together? So which at the end of it in this case, Y M, this is S. So Y MPS minus A should be what? The saving functions. Saving functions, which in this case is the investment what? Function, which is Y MPS, that is marginal propensity to save, minus the autonomous consumption, which should be equal to what? Save. Sawa. Now we can try one example here very fast. When they ask about the saving is also the investment function. Are we together? So when you check on the sitting of May 2019, and that is question number 5D. May 2019 question 5D. May 2019 question 5D. Now the data relates to the consumption function of a hypothetical economy in millions of shillings. We have C is 300 plus 0.6Y. Y is the national income. C is the consumption function. You are required the investment what? The investment function. So that's how. So investment function in this case, which is savings, is required to be Y MPS minus A, which in this case is the autonomous what? Consumption. So in this case, we know we've been given the consumption function, which in this case is how much? 300 plus 0.6 Y. Are we together? So already we know this is our A. What we don't know is the MPS. And what will be our MPS? MPS, we know it is 1 minus MP. We know MPC. This is our MPC. Are we together? So in that case, I can take 1 minus 0.6, which in that case it will be 0.4. So in that case, it will be 0.4Y minus 300. That is the investment function. That is now the investment function. The investment function. And that is how you compute for that case. That is how you compute for that case. Now, the other thing is also what we call the multiplier function. Multiplier function. Multiplier functions. The multiplier function multiplier function. Multiplier function. Multiplier function. Now, when we talk about multiplier in this case is a ratio stroke what we call the coefficient of change in gross domestic product to the changes is in autonomous expenditure that is brought about. So generally for this case, the multiplier in this case normally shows the changes in marginal propensity to save. And we can also as well develop the multiplier. And how will you develop this? Y should be equals to C plus what? Consumption plus savings. Are we together? Whereby in this case, savings should be the same as what? Investments. So that is what we've said. Saving is equals to investments. So meaning that if I say here Y should be I, or in this case, I can add O, which in that case is now the investment savings. That is the consumption, the investment. And therefore, in this case, we know C is equals to A plus what? BY. Are we together? So in that case, Y will be A plus BY plus IO, which in that case is the investment savings. Group the lifetimes together, Y minus BY, which is equals to A plus IO. This is Y, 1 minus B is equals to A plus I, which in this case, Y will be A plus IO. You divide by 1 minus B. 1 minus B. We know this B is the MP what? MPC. So in this case, it is A plus I over O all over what? 1 minus MPC. That is marginal propensity to consume. Are we together? So then what is then our Y? It will be Y will be equals to what? 1 minus MPC is marginal propensity to do what? So A plus IO all over what we call the marginal propensity to save. Marginal propensity to save. So if in this case, it just means that is A all over MPS plus IO out of MPS. Now we know in this case, when we talk about A, this one hii unaweza iachia hapo. This is just autonomous consumption. What we base on is now on the investment. Remember in this case is when we talk about this one, we said is what is being or brought about by the expenditure. So in that case, if this case, I O over MPS, this means is IO, you multiply by 1 over what? MPS. Sawa. Are we together? I've said in this case hapa nimeachana nayo. I'm basing on this because I want to develop the multiplier function. The multiplier function in this case, I've said we develop it out of what? The investment function. Now, the multiplier function in that case is now what we have here. 1 over MPS. This is now the multiplier. So multiply in this case is just 1 over what? Marginal propensity to save. That is now what we call the multiplier. And therefore, in this case, the multiplier is just the reciprocal of what? Marginal propensity to save. Remember, is out of, when we talk about investments, they are also the savings. Are we together? So in that case, that is how you're going to get that. So meaning that the higher the marginal propensity to consume, the higher the multiplier, I mean. Sindio? Because if in this case the marginal propensity to consume iko juu, multiplier hata hapa itakuja kuwa juu. Are we together? Because for us to get this, we have to take this minus the marginal propensity to consume. So if in this case the marginal propensity to consume is higher, the multiplier will also be higher. That is what you need to be aware on that case. So with that, we can as well try an example here to understand on how we can get the multiplier. To understand on how we can get the multiplier. So can try an example. November 2015, November 2015, question number 4C, November 2015, question 4C. November 2015, question 4C. November 2015, question 4C. C. The following information relates to savings and investment of a certain economy in millions of shillings. Being given the saving functions and also the investment functions. Being given the saving function, we also have the investment function. You are required the consumption function. Then the other one, we also require the equilibrium level of national income. Then also they need you to get the multiplier, equilibrium level of national income, and then the multiplier. Now for the consumption, now that we've been given the saving functions, now that we've been given the saving functions, saving function tulisema ni nini? Saving function is YMPS minus A. So in that case, we've been given there, which is how much? Minus 500, which is our A, plus 0.36 Y. Are we together? We know this is MPS. MPS is 0.36. Are we together? So what will be our the consumption function? Consumption function, we know it is A, B what? A we know in this case is how much? A itakuwa 5 what? So this is A, which is negative. A will be 500. But in this case, we are not going to use negative. Remember, is our what? Is a positive. The reason for this, for the multiplier lazima, for the saving lazima equal what? Negative. But for the consumption in this case, it must be positive. Then plus B, we know this is MPC. B is the MPC, which in this case is just 1 minus what? Which in that case is giving you how much? Which in that case, it will give you how much? 0.64. So in that case, it will be 0.64 Y. That is the consumption function. That is Roman number 1. That is Roman number 1. The Roman number 1. Now Roman number 2, we also need to get the equilibrium level of national income. That is Roman number 2. Now the equilibrium level of income, the national income in this case will be equal to the consumption. You add the investments. You also add the what? The government expenditure. You also, remember is what we talked about, the aggregate demand. You add the exports to minus the imports. But in our case, what we have in here is just the consumption and what? Consumption and investment. So Y will be equals to the consumption, which is 500 plus 0.64Y. Then you add the investments. Investment is of how much? 8,000. So in that case, it will be given by how much? You group the like terms together, Y minus 0.64Y should be equals to 8,500. So in that case, 8,500. So in that case, this one will be how much? 0.36Y is equals to how much? 8,500. So what will be the equilibrium level of national income? 500 you divide by 0.36. which in that case it will be 23,611. And that is how you get the equilibrium level of national income. Then the other one is also the multiplier. So multiplier in this case is being given there. Now multiplier we just said is 1 over MPS. Multiplier Roman 3. Multiply in that case is just 1 over MPS. And what was the MPS? 0.36, which in that case is 1 minus 0.36, which will give you how much? 1 divided by 0, no, divide by 2.7. That is the multiplier. And that is how you get the multiplier. That is how you get the multiplier. Sorry? We say that the higher the MPC, the higher the multiplier. So in this case, when you see that MPC is a bit higher, so in that case, you can just talk of it as you can talk of it being that the higher the MPC, the higher the multiplier, and our multiplier in that case is 2 point what? So when you check on that case, in this case, the multiplier is higher. So what does that mean? Now, the relevance of multiplier in this case, normally, multiplier it operates under the following conditions. That number one, or it will exist when the following conditions must be met, do not exist, I mean. When the following conditions do not exist. Now, one of it is whereby the supply of goods and services must be elastic. So if the supply of goods and services are elastic, kumaanisha in this case, if that the multiplier will be useful. But if in this case is not met, then in that case the multiplier will be not useful. Then also, if there is there should be a sufficient excess capacity in the economy. The sufficient excess capacity in the economy. The supply of raw materials and working capital should also be elastic. And also the other one, workers seeking jobs will be able to find employment as a result of the income. Workers seeking employment will be able to find employment. By the way, this is a question on May 2017, question 5D. May 2017, question 5D. On May 2017, question 5D. Yes, 5D. Now, before you explain the distinguish between the multiplier, and also down there you talk of the factors that may limit the application of what? The multiplier, and that is the one that we've been able to talk about. The one that we've been able to talk about in that case. So then Still on the same question is asking about what is an accelerator. That is on that question of May 20 what? Yes. Now this is out of what we call the acceleration principle. When we talk about the acceleration principle, this is just a ratio of induced investment to autonomous increase in income. So in this case, the acceleration principle is just like the autonomous expenditure, whereby in this case, you normally get it by taking the changes in investment, you just divide by the changes in investment. But in our case, we want to talk of the accelerator. The accelerator in this case is the factor by which an increase in income is resulting to an initial increase in investment is multiplied to give the induced investment, is multiplied to give the induced investment. That is what we mean when we talk about the accelerator. Now, there is also another area we call, we have what we call the actual income, and in other cases, what we call the full employment. Actual income, and then we have the full employment. Actual income and full employment. This is giving rise to what we call the deflationary gap, and also we call the inflationary gap. Actual income, and then we also have under full employment. Full employment income. Full employment income. Now, full employment income is the national income that will be produced when the country's factors of productions are fully employed. That is what we call the full employment income. But for the actual national income, in this case, is just what is realized out of, for example, different sectors of an economy. So in that case, it's normally symbolized by YF, YE, I mean, which in this case is always can be below or above what we call the what? The full employment. So this is now what happens in this regard. We'll have the expenditure. And then we'll also have what we call the what? We'll also have the income. We are talking about the income. So for this one, this is now out of what we call in the actual income, the actual income and full income. Now, we'll have that, and then we'll also have, let me just have it from the start here. And then for the other one, we can have it from here. This is now Y, where the national income, which should be C plus S, which should also be equals to C plus S plus also the investments. Not the investment plus the taxes. In this case, we are talking about, the taxes. Then for this one is the expenditure. Expenditure is normally given by, this is for the income, this is the expenditure, consumption plus saving, I mean the government expenditure, as the investment plus exports minus imports. So for this one, we have at this point, this is now what we call in the actual income, which is YE, the actual income. Now, we also have what we call, as a result of what we call the inflationary gap. Now, when we talk about the inflationary gap, It is said to exist where the aggregate expenditure exceeds the maximum attainable level of output. That is what we mean when we talk about inflationary gap. When you talk about the deflationary gap is whereby the aggregate expenditure will now fall short of the what? The required the amount that is required to be produced, or generally the output. So in this case, as a result of that, for the deflationary gap it appear, whereby in this case this is now the output. Remember, that is the output, and then we have what we call the output is out of the national income, which is this one. So if in this case it exceeds, in this case it exceeds the what we call the maximum attainable level of output, kama hapa ilikuwa exceed up to here to this point. When you check on this case, this is the output. But now in this case, the national income is the aggregate demand is exceeding that. When the aggregate demand is exceeding the output, the expenditure, or the aggregate expenditure, that is now what we call the inflationary what. Ukiangalia hapa iko juu. But out of that, after that, that is now what we call the deflationary gap, whereby now the output is exceeding the what? Expenditure. Now, expenditure in this case is the one that is exceeding the output. But after this point, that is that YE, which is now the actual income, when it exceeds that, whereby you find the output is now the one that is exceeding the expenditure, that is now what we call the what? Deflationary gap. This is inflationary, whereby the aggregate expenditure will exceed the output, and that is what we mean in that regard. Now, that is what we mean. So we can try an example here again on December 2017 question number 2014 question 4C. December 2014 question 4C. December 2014 question 4C. December, not 4C, but 7C. December 2014, question 7C. December 2014, question 7C. The data provided below, represents the national income model of a certain economy in billions of shillings. Being given the national income where is Y is equal to C plus 1 plus D, then C is equals to that T we've been given there, I at G. Then you have the Y is national income, C is the consumption expenditure, I is the investment, G we have the government expenditure, then we have D, which is the disposable income, and then we also have what we call the what? Taxes. You are required the equilibrium level of national income, consumption, and also the taxes. So in this case, Y is supposed to be given by C plus investment plus the government what? Expenditure. So Y will be equals to consumption in that case we have, which is 100 plus 0.8 YD, right? Then plus investment we've been given there is 50, then plus 30. 50, then plus 30. That is now what will be given on that regard. Now, YD we've been given is the nation, the personal or the disposable income. And disposable income, we said we normally take the personal income minus the what? Taxes. So the personal income in this case, we normally take it as the national income, whereby you take the national income, you less the what? You less the taxes. So generally, all that is the YD, you can take, we say this, yeah, personal income, whereby in that case will be Y is minus what? Y minus T. That is the national income. So in that case, how will we get that? In this case, it will be given by Y is 100 plus 0.8 YD. So in this case, we'll take the Y minus the taxes. Taxes hingapi? Taxes is 10 plus 0.1 Y. Then plus 50 plus 30. That is how you're supposed to do that. YD is the national personal income to less the taxes. So in that case, that this is the national income, you minus what we have in as the what? As the taxes. So from there now, we can solve. In this case, it will be Y is equals to 100 plus 0.8 Y minus, this will be 8. This is 8. That is 0.8 Y minus 0.8, 10 plus 0.1 Y plus this will be, that is 80. That is 80. So in that case, this will be Y is equals to 100 plus 0.8 Y minus this will be 0. That is 8. That will be 8 plus minus 0.08 Y plus 8. That is how it's supposed to be now. So you group the like terms together. So it will be Y. In that case is Y plus what? When you take 0.8 minus that, this will be Y. Hii ukileta this side utaless. So it will be Y. Right? Tumefanya vizuri. 0.8 plus this will be 0.08. Sindio? Is it supposed to be plus or minus? It is minus. So in that case, what is 0? Yeah. So in that case, it will be Y minus 0.8 Y, then plus 0.0. We are grouping the like terms together, which will be 100 minus 8 plus 8. So in this case, we give you how much? This is 0.2, 0.28 Y, which is supposed to be equal to how much? 172. So Y will be equal to how much? Y is equal 614.29. That is how you get the national income. That is the Roman number 1. Remember, national income, I said, is denoted by Y. Then Roman number 2. Personal incomes. How do you get the personal incomes? I mean the disposable income. I mean personal income is what we take in as the national income. Are we together? We take in as national income, you less the taxes. So in that case, that is how we've done there. So then Roman number 2, consumption. Now the consumption in there, we've been given the consumption function, and the consumption function is 100 plus 0.8 YD. Consumption is 100 plus 0.8 YD. So in that case, we know YD. YD in this case, we said will be equal to how much? The national income minus. So we can in fact do it as a whole. So we know the national income here, which is this one. So it will be 614.29 minus the taxes, we know them. The taxes in this case we've been given there, which is 10 plus 0.9 what? 0.1 national income, which is 624, 614.29. So in that case, it will give you how much? What will be YD? What will be YD? YD 0.1, 5.542, 862. So meaning that the consumption here will be 100 plus 0.8, 542.862. So 542, 68862. You multiply by 0.8. Then you add 100. 530, 2896. That is how you get the consumption here. That is how you get the consumption. So this is 0.1, you multiply by 614.29, that's 10. 614 into 9. Yeah, that is how it's going to give you. It's giving you 740 what? Yes. $534 point that. That is how you get the consumption function. So the last one is asking about the taxes. So the taxes, you also have the taxes in this case we know is 10 plus 0.1. Y? Y is 6 what? 614. 614. Yeah, 614.29. So in that case, it will give you the Y, which in that case is supposed to be 70 what? Is it 71.429? 71.429. That is how you get the value there. 71.29. So that is what you need to know on that area. So I want to just talk about the money and banking briefly so that we can as well do a question on the same money and banking. Money and banking. So on money and banking, when we talk about money, this is anything that is generally accepted as a medium of what? As a medium of exchange. So you need to look on the characteristics of money. You also need to know the functions of money. And then there is what we call the demand for money, or what we call the liquidity preference for money. Now this one is money and banking. Money and banking. So these are, when we talk about the liquidity preference for money, this explains why individuals prefer having cash immediately than having the same cash in future. Why you will require to have money as a now in, I mean, not just individual preferring have money as a now. Now in this case, we mean when we talk about the liquidity preference for money, this is whereby people will prefer keeping their money in their pockets rather than buying an asset or investing on that money. Are we together? Why you love to keep the money unaiweka kwa mifuko yako, lakini huwezi weka hiyo pesa in form of an asset. What do you mean? You can buy an asset na hiyo bado ikuwe pesa. Are we together? That is what we mean in this case. So it explains why a person prefer to keep part of their wealth in form of money instead of physical and financial assets. And this is as a result of the following. Number one is what we call the transaction demand. Transaction demand is necessary for financing non or any current or future requirements. Then we like food or clothing. We have precautionary. This is where money that is held ready to meet the non-what or urgent needs. And then kuna speculative. Whereby in this case you may be expecting changes or changes in the interest rates and so forth. So in that case, for these ones, we can try an example on May 2016, question number 5B, for us to understand more of this. May 2016, question 3. Is it 3 or 5B? Yeah, 5B. May 2016, question 5B. May 2016, question 5B. Question 5B. The following data relates to the commodity and money markets of a hypothetical closed economy without government intervention in millions of shillings. We have the consumption, we've been given the investment. Then we have the MDT, the MDS, and we have the MS, which is money supply. C is the consumption function. Y is the national income. I is the investment function. R is the interest rate. MDT is the precautionary and transaction demand for money. MDS is for speculative for money. And then we have M, which is the money supply. When you talk about the money supply, it refers to the value of all the liquid assets in an economy. Then you require the equilibrium level of interest rates and the equilibrium level of national income. Now, when you talk about equilibrium, remember demand is equal to what? supply. Sawa. So when we talk about the money demand, we're talking about the demand, the liquidity preference, the demand for money, whereby in that case at equilibrium, the money demand should be equal to what? Money supply. So when you talk about the money demand, you are requiring this demand for what? Transaction what? Sindio? You require it for the transaction purposes. You also require it for the speculative purposes. Sindio? You also require it for the what? Si tumesema precautionary. Sawa, which in that case should be equal to the money supply. That is one of the things. So in this case, we were given for the MDT, that is for the transactional demand. So in that case, for the transactional demand is how much? 0.25. We've been given for the precautionary, which is 248 plus what? Minus 200R should be able to give us what we call in what? Should give us MS, which is money supply, which is 600. Money demand at equilibrium should be equal to money supply. So in this case, you have 0.25. Y is equal to 600 minus 248. Then you add 2000 R, whereby in this case, Y will be equal to 600. Y will be equal to 600 minus 248, which in that case is 352 plus 200 R. You divide by 0.25. So what I'm trying to develop here is what we call the liquidity money preference. Are we together? LM function. We call it the liquidity money function. Liquidity money function in this case is derived out of the money demand is equal to money supply. Kwa pamoja? That is what we call in the LM function. In other questions, they will call it the LM function. Are we together? So in that case, this one will be 352, you divide by 0.25, which in that case, it is 1408 plus 200, you divide by 0.25, which in that case, it will be 800R. This is, in other questions, watakuuliza what we call the LM function. LM function in this case I've said is the liquidity money. Remember this one, we have derived it from the what? Liquidity preference for money, which in this case is demand for money. So then from there, you will also be required to look for what we call the investment saving function. Now, investment saving functions in this case is out of what we call the commodity function, or generally what we call the investments. Now, investment function, or in this case, we can call it the commodity function, or in other cases, is out of the market function. We can also call it the investment what? Saving function. In other cases, they will call it the what? Investment saving functions. Are we together? So the investment in this case, you normally say Y is equals to consumption plus what? Investment. Are we together? So in our case, we have it there whereby Y is Y will be equals to 204 plus what? 0.7Y plus the investment saving, which is 300 plus what we have in minus 100R. Minus 100R. Sawa. So in that case, we group the like terms together. Y will be equal, Y minus 0.7Y is equals to 504. This is this plus that minus 100 what? R. This will be 0.3Y is 504 minus 100R. So in that case, you take 5 over 4 divide by 0.3, which in this case it will be 16.8 minus, you divide by 0.3, which is 333R. And this is now what we call the IS. You tell this what is an IS function. So now from there, we can now be able to get why in this case is our equilibrium national income. Are we together? So first we want to know the rate. The rate is here, sawa sawa. So this is how you normally say the LM function should be equal to IS function. Sawa sawa. LM, that is the liquidity money function, should be equal to the investment function. So our liquidity money function, because in this case, at the end of it, this is the national income, we should also be the same. Are we together? Why is the national income? So in that case, this one will be 1408 plus 800R should be equal to 1680 minus 333R. So whereby in this case, we can have 800R minus 333R should be 1680. Later on this side, this one will add. Later this one on this side, you'll have to less 1408. So this one will be, this is for 200. 1680 1408. Is it 272? Is 1680. So in that case also we have this one is 800 plus 333, which is 1133R. So R will be how much? 272 divided by that, which is 0.2. That is the R, the interest rate, 24%. So meaning that now we have the R, that is on Roman 1. Roman 2, we can now get the equilibrium level of income. You just pick any of these. Y should be 1408 plus 800, which is 0.24. So in that case, it will be 1408 plus 800 multiplied by 0.24, which in that case, it will be how much? 1600. And that is how you are required to do on that case. So meaning that if you are also on the same, like for example, in the sitting of May 2019 question 7C, you can be able to do that. So we'll continue from there in our next area, in our next class.